Let's get back to the markets right now. Positive start on this Friday. The TSX, which is coming off its best session in more than a year, adding another near 150 points. In the U.S., we are higher right now. And we mentioned the dynamics are as such. You've got signs of cooling employment pictures in both countries, but that seems to give investors an indication that this idea of staying hawkish, keeping rates higher for longer, or even raising rates more in the fight against inflation is a narrative that's going to lose momentum. And we want to get some perspective from JoAnne Feeney, partner and portfolio manager at Advisors Capital Management, somebody who also has plenty of experience in navigating central bank policy. She was a consultant to the Fed and the IMF and the World Bank. JoAnne, nice to have you back with us. Appreciate the time.
Good morning, John. Good to be with you.
What's your assessment of what's happening in the markets right now?
Well, I think three words can summarize what's been happening with the markets: the Fed, fundamentals, and fear. And the Fed you've just talked about, and right now is dominating today's action, I think, with the latest job numbers coming in a little bit light. That's a good thing from the market's perspective, because those interest rates determine the price of and the value of stock earnings in the future. And so a lower discount rate, higher valuations, that belief that the Fed could be done is encouraging to folks, because it means that, okay, interest rates may not go any higher from here, and eventually they'll actually come down. But then we turn to fundamentals, and the fundamentals are the earnings reports that we're seeing, and they've been largely pretty good. And so the fear of the world, sort of, everything falling off a cliff, does not seem to be coming to pass, yet we are seeing signs that do cause some concern. And then finally, fear. Fear that recession that's been put off so far may be around the corner. We see that fear ebb and flow. Right now, the fear seems to be abating in the wake of that slightly weaker but not disastrous jobs report.
You are well suited for this next question. I've been hearing this the last couple of days. The fact that now that the market's interpretation of Chair Powell's comments is that maybe we're not going to see more rate action to the upside, that that investors were bidding down bond yields, and that all of a sudden the tightening work that can do, that the Fed doesn't have to do, then doesn't get done. And then the Fed itself is going to have to focus on tightening again. How do you feel about that narrative?
Yeah, that whole circular logic is what we in economics call a fixed point problem. Yes, the interest rates in the private market dynamics going up helps to do the Fed's job for it. And then if the Powell comes out and says, so you guys are doing the job for me, and then the market says, okay, so rates don't have to go up anymore, and so those yields come down again. And we circle and circle around until we get to the point where things are at an equilibrium. I think that the Powell and the Fed are being as careful as they can be to let the market know that the 2% inflation goal is a hard goal, that they're going to get to that point, and that financial conditions have to be tight, relatively tight, in order to get there. Now, the market still has to figure out what's the path of interest rates that's consistent with getting there. And I think the market probably did get a little bit ahead of itself in pushing rates up as high as it did because of that last jobs report that was so strong. But that doesn't mean that rates aren't sufficiently tight now, even at these lower levels. Because if you look at some of the earnings reports, if you see the industrial companies, for example, some of the tech companies, saying things really are slowing down. There is less spending going on. You look at some of the equipment suppliers to the healthcare industry, for example. They have across the board been saying that spending is down. They've been pushed out in terms of the orders they're seeing. Companies like Agilent or Thermo or Danaher, for example. And you look at the industrials like Caterpillar, and they're seeing a slowdown. You look at the chip companies that are really good gauges of what's going on in the broader economy, whether it's Texas Instruments or Microchip last night, saying things are slowing down. They are reducing the utilization of their factories because demand is slowing down. That tells you something about how much tighter financial conditions are really impacting economic activity. So it's working, what the Fed is doing. We are getting there.
And then, I guess, against that backdrop, people are still having to do this balancing act on where the economy goes. What does that mean for these companies? You always come to the table with a range of ideas. You've got growth, protection and some income ideas worked into a few stock ideas you brought to the table today. Walk us through what you're thinking right now.
Yeah, I think one thing you have to think about as an investor is you have to look beyond cyclical changes, and we're in the middle of one. And so those ideas I like to think about for investors include some of the long-term secular growth engines for the portfolio. These are companies that will grow over time because they're an essential part of how the world is changing, for example, whether that's a Microsoft, a Palo Alto Networks, which is cybersecurity, where we're going to see a lot more attacks, a lot of fear now, given what's going on in the Middle East, that those attacks are going to be ramped up. Or a company like Broadcom, which is a company that's broadly exposed both to cyber and to cloud and to AI, where Microsoft also plays. So those are your growth engines, but you also want some protection. You want some income generation on the one hand and then protection to the downside on the other. Income generation helps you ride out the fluctuations in stock prices. So you get a really well above average dividend yield out of a Chevron, for example, or an AbbVie in the healthcare space, or even an IBM in the tech world. And that helps you ride out some of the cyclical fluctuations. And then also just pure downside protection, like own McDonald's, own TJ Maxx. These are places consumers go when times are tough. And so they tend to hold up pretty well in terms of their sales and their profits, even during cyclical declines. And so that can provide some protection for the portfolio.
JoAnne, great